There's a new rule that could put up to $2,750 back in your pocket this year, but almost nobody's claiming it correctly. It's called the overtime deduction. It came from a law called the One Big Beautiful Bill Act. That law was signed in July 2025. And if you work overtime hours at your job, this could seriously change how you file your taxes for the next 3 years. But here's the catch. The way most people understand this rule is completely wrong, and that misunderstanding is costing them real money. By the end of this video, you'll know exactly how much of your overtime pay is deductible, whether you qualify, and the 5 steps to claim every dollar you're owed on your tax return. You'll also learn the one mistake that's costing most workers hundreds of dollars, and it's a mistake almost everyone is making right now. Quick note, I'm not a financial advisor. This isn't personalized advice. It's what the data shows and what the math says. Always do your own homework before making money moves. Now let's get into it, and let me be clear, and I'm going to take this slow because this topic has a lot of fine print that most creators are skipping over. You've probably heard the phrase no tax on overtime. It was everywhere, news headlines, social media posts. Your coworker in the break room probably mentioned it, and most people heard those 4 words and thought, sweet, my overtime is tax-free now. Here's the thing, that's not what happened, not even close. Let me tell you what nobody told you. Your overtime is not tax-free. You still owe Social Security tax on it. You still owe Medicare tax on it. And in most states, you still owe state income tax on it too. What you actually got is a federal income tax deduction. And those are 2 very different things. A deduction doesn't erase your tax bill. It reduces your taxable income. So you pay tax on a smaller number. That's it. Think of it like a coupon. You're not getting the item for free. You're getting a discount. So the question becomes, how big is this discount and how do you actually use it? That's what this video is about. So what does this deduction actually cover? Let's break it down step by step. Step 1, understand what's actually deductible. When you work overtime, you usually earn time and a half. That means your employer pays you 1.5 times your regular hourly rate for every hour over 40 in a work week. So if your regular rate is $25 an hour, your overtime rate is $37.50. That sounds pretty good, right? But here's where most people get confused. The deduction doesn't cover that whole $37.50. It only covers the premium, the extra half. In this example, only $12.50 per overtime hour is deductible. Not the full $37.50, not even the full $25, just the $12.50. Why? Because the law says only the compensation that exceeds your regular rate qualifies. The regular portion is treated like your normal paycheck. It's the bonus on top, the premium, that gets the deduction. Think of it this way. When you work overtime, your employer is paying you your regular rate plus a bonus. The deduction only applies to the bonus part. Here's a quick way to figure out yours. Take your total overtime pay for the year, not your regular pay, just the overtime, and divide it by 3. That gives you the approximate premium portion. That's the number you can deduct. Why 3? Because time and a half means your overtime rate is 3 halves of your regular rate. The premium is one of those 3 halves. So dividing by 3 isolates the deductible portion. Let's say you earned $15,000 in overtime last year. Divide by 3. That's $5,000. And that $5,000 is what you can deduct from your federal taxable income. Now, what does that actually save you in real dollars? It depends on your tax bracket. If you're in the 22% bracket, which covers single filers earning between about $48,000 and $103,000, that saves you $1,100. $1,100 from money you already earned. That's real. And if you're in a higher bracket, the savings go up. At 24%, that same $5,000 deduction saves you $1,200. Not life-changing by itself. But it adds up, and most people are leaving it completely on the table because they don't know the rules. Step 2, check if you actually qualify. This deduction isn't for everyone, and this is where a lot of people get disappointed. There are 4 boxes you have to check. Miss one, and you're out. First, you have to be a W-2 employee. That means someone who gets a paycheck from an employer with taxes withheld. Independent contractors, you're out. Freelancers, out. Gig workers driving for a ride-share app, also out. This only applies to traditional employees who receive a W-2 at tax time. Second, your overtime has to be required under the Fair Labor Standards Act. The FLSA is the federal law that says employers must pay time and a half for hours over 40 in a work week. Here's where it gets tricky. Not all overtime is FLSA overtime. If your overtime is only required by your state's labor law, it might not qualify. If it's required by your union contract, doesn't qualify. If your employer voluntarily pays you overtime even though they don't have to, doesn't qualify either. The only overtime that counts is overtime that your employer is required to pay under the Federal Fair Labor Standards Act, period. If you're unsure whether your overtime falls under federal rules, ask your HR department. They should be able to tell you whether you're classified as a non-exempt employee under the FLSA. Third, your income can't be too high. The deduction starts phasing out at $150,000 for single filers. That's $300,000 for married filing jointly. For every $1,000 you earn over that limit, you lose $100 of the deduction. So if you're a single filer earning $160,000, you'd lose $1,000 of your maximum deduction. We'll go deeper on this math later. For now, just know the threshold exists. Fourth, you can't file as married filing separately. You also need a valid Social Security number. And if you're married, both of you have to file a joint return to claim this deduction. If you checked all 4 boxes, congratulations, you're eligible. Let's move to step 3. And coming up in a few minutes, I'll show you the exact calculation that could be worth up to $2,750 per year. But first, let's talk about the cap, because even this deduction has limits. Step 3, know your cap. Even if you work a massive amount of overtime, there's a ceiling on this deduction. The maximum deduction is $12,500 per year if you file as single or head of household. If you file jointly with your spouse, the cap is $25,000. Let's put that in real-world terms with a realistic example. Say you make $25 an hour at your regular rate. You work 10 hours of overtime every single week, and you do that for 50 weeks a year. That's 500 overtime hours. At $37.50 per hour, your total overtime pay is $18,750. Now divide by 3 to find your premium. That gives you $6,250. $6,250 is well under the $12,500 cap, so you deduct the full amount. At a 22% tax rate, that's $1,375 back in your pocket. Now let's look at someone who works even more overtime. Let's say you're a nurse or a manufacturing worker pulling serious hours. You earn $30 an hour and work 15 overtime hours per week for 50 weeks. That's 750 overtime hours. Your premium is $15 per hour. Total premium for the year, $11,250. Still under the cap, you deduct all of it. At 22%, that saves you $2,475. But what if your premium goes over $12,500? Then you hit the ceiling. You can't deduct more than the cap, no matter how many hours you work. Now here's where the math gets really interesting. If you max out the deduction at $12,500 and you're in the 22% bracket, you save $2,750. At 24%, $3,000 saved every single year for 4 years. And speaking of 4 years, this deduction isn't permanent. It runs from 2025 through 2028. That's it. After that, it's gone unless Congress passes a new law to extend it. So if you qualify, don't wait. Start claiming it now. Every year you skip is money gone forever. Let's add it up. If you max out the deduction every year for all 4 years at the 22% bracket, that's $2,750 times 4. That's $11,000 over the life of this provision. $11,000 from a deduction you might already qualify for. Now let's talk about the part most people get wrong, and trust me, this is the section that could save you from a costly mistake. Step 4, avoid the biggest mistake. Here's the common mistake I see everywhere, on social media, in comment sections, even from people who should know better. People look at their total overtime earnings for the year and think that entire number is deductible. It's not even close. If you earned $18,750 in total overtime, your deduction is not $18,750. It's $6,250. That's a difference of $12,500 in claim deductions. If you claim the wrong amount, one of two things happens. Either the IRS catches it and adjusts your return, or worse, you could face penalties for overstating your deduction. The fix is simple. Remember the rule from step 1. Divide your total overtime pay by 3. That gives you the premium. That's the number that goes on your tax return. Write it down, tattoo it on your brain. And here's another mistake that's just as common. Some people think this deduction means their employer should stop withholding taxes from their overtime paychecks right now. That's wrong. Your employer still withholds all federal taxes on every paycheck, including overtime. Nothing changes on your paycheck. You claim the deduction when you file your annual tax return. The benefit shows up as either a bigger refund or a lower tax bill at filing time. This isn't a paycheck change, it's a filing change. Those are two completely different things. If someone tells you your check should look different, they're misinformed. Now let's talk about what to do if your employer pays double time instead of time and a half. Some employers are more generous. If you earn double your regular rate for overtime, the deductible portion is different. With time and a half, you divide by 3. With double time, you divide by 2, because the premium, the amount above your regular rate, is equal to your regular rate. But here's the important caveat. If your employer pays double time voluntarily, meaning the FLSA doesn't require it, only the FLSA required portion qualifies. The extra is not deductible. So if you get double time but the FLSA only requires time and a half, you can only deduct the time and a half premium, not the double time premium. I know, it's complicated, but that's exactly why this video exists. Stick with me. And coming up, I'll walk you through exactly how to claim this on your tax return, whether your employer reported it for you or not. This is the step where most people freeze up. Don't worry, I'll make it simple. Step 5. Actually claim it on your return. Here's where the rubber meets the road. You know the rules, you know the math. Now let's talk about what you actually do when you sit down to file. For tax year 2025, the one you're filing right now in 2026, your employer was not required to separately report your overtime pay. The IRS gave employers a pass for the first year. Some employers voluntarily reported it anyway. They put the amount in box 14 of your W-2 form. Others sent a separate statement. But a lot of employers, they did nothing. And that's technically fine for 2025. If your employer didn't break it out, don't panic. The IRS says you can calculate it yourself. Here's how. Gather all your pay stubs from 2025, every single one. Add up your total overtime hours for the year. Multiply those hours by your overtime rate to get your total overtime pay. Then divide that number by 3. The result is your deductible amount. Let me walk through a real example. Your overtime rate is $30. If you worked 400 overtime hours in 2025, your total overtime pay is $12,000. Divide by 3, that's $4,000. At 22%, you save $880 on your federal taxes. Not bad for a few minutes of math, right? Now keep those pay stubs. File them away somewhere safe. The IRS says you need documentation to support your deduction if they ever ask. Your pay stubs are your proof. Starting in 2026, things get much easier. From this year forward, employers are required by law to separately report your qualified overtime compensation on your W-2. It'll show up right there in a designated field. No more digging through pay stubs, no more doing the math yourself. It'll be in black and white. You claim the deduction on Schedule 1A, which is part of your standard Form 1040 filing. And here's the best part. It's an above-the-line deduction. What does above the line mean? It means you get this deduction whether you itemize or take the standard deduction. You don't need to jump through extra hoops. You don't need to itemize your mortgage interest or charitable donations. If you qualify, you get it, period. That's a big deal because most Americans take the standard deduction. Now here's the part most people skip. Don't skip this. This deduction also lowers your adjusted gross income. You might think, so what? But your AGI is the number that determines your eligibility for dozens of other tax benefits. When your AGI goes down, you might suddenly qualify for credits and deductions that were out of reach before. You might qualify for a bigger education credit. You might become eligible for a Roth IRA contribution. You might get a larger child tax credit. So this $12,500 deduction isn't just about saving you money on the surface. It could have a ripple effect that unlocks other benefits across your entire tax picture. This is why I always say, talk to a tax professional, especially if your income is anywhere near the phase-out thresholds. A good CPA can tell you exactly how this deduction interacts with your complete tax situation. All right, deep breath. Let's bring it all together. The overtime deduction checklist, your 5 steps. Screenshot this. Step 1, understand what's deductible. Only the premium half of time and a half qualifies. Divide your total overtime by 3 to find your deductible amount. Step 2, check your eligibility. You need to be a W-2 employee earning FLSA overtime with income under the phase-out threshold, and you can't file separately. Step 3, know your cap. $12,500 for single filers, $25,000 for joint filers. You can't deduct more than these amounts no matter what. Step 4, avoid the biggest mistake. Don't deduct your full overtime pay. Only the premium counts. Divide by 3. Step 5, claim it on your tax return. Use Schedule 1A on Form 1040. It's above the line, and keep your pay stubs as proof. Now let me put this into perspective with some bigger numbers. Over 60% of Americans work in jobs that are eligible for overtime pay. About 20 million workers regularly earn overtime hours. That's 20 million people who could be claiming this deduction right now. How many of those 20 million do you think know the rules we just covered? How many know to divide by 3? How many know it's above the line? Probably not many, but now you do. Let's also talk about the phase out in more detail, because this matters if you're a higher earner. The rule is straightforward. For every $1,000 your income exceeds the threshold, your maximum deduction drops by $100. If you're single and earn $160,000, you're $10,000 over the limit. You lose $1,000 of the deduction. Your max drops from $12,500 to $11,500. If you earn $200,000, you're $50,000 over. You lose $5,000. Your max deduction is $7,500. And if you earn $275,000 or more as a single filer, the deduction is completely gone. But here's the important takeaway. Even if your deduction is reduced, it's still money. A $7,500 deduction at 24% still saves you $1,800. Don't leave it on the table because it's not the maximum. One more critical thing before we wrap up. This is a federal deduction. That means it only reduces your federal income tax bill. Now, some states automatically follow federal tax law. If your state does that, you'll get a state-level benefit too. Your state taxable income will also go down. But other states have already said they will not honor this deduction. They're decoupling from the federal rule. In those states, you'll still owe full state income tax on your overtime, even though you got a federal break. The bottom line, don't assume your state follows the feds. Check with your state's Department of Revenue or ask your tax professional. A quick phone call could clear it up. Here's your one takeaway from this entire video. The no tax on overtime rule is real. It exists. You can use it, but it's a deduction, not a full exemption. It covers the premium half of your overtime, not the full amount. It's capped at $12,500. It expires in 2028, and you have to actively claim it on your return. That's the move. Money made simple. If this was useful, you'll want to see the $1,000 Trump account trap. One wrong move could cost your kid $300,000. I'll link it right here.